When my dad retired from teaching high school in 1991, he bought a long-term care insurance policy. In 2009, he fell while stepping off the curb and he hit his head. When I saw him a week later, he was talking less than usual and struggling to get out of chairs. He never really recovered. 2 years later, he canceled his long-term care policy, a policy he'd had for 20 years. And 2 years after canceling the policy, he had a severe stroke and spent the last year of his life in long-term care facilities, uninsured. Throughout most of his life, my father was a smart man with a good head for numbers and finance, but canceling his long-term care policy at 85 was a bad financial decision. Dad was no longer thinking clearly. He bought insurance to protect against cognitive and physical impairment that might make him unable to care for himself. But when cognitive impairment set in, he was vulnerable, not protected. How can we protect ourselves against our own bad financial decisions when we get older? Nearly 1/3 of people over 85 suffer from dementia, and nearly 1/3 have cognitive impairment without dementia. On average, scores on financial literacy tests drop by about 1% a year as we get older. However, on average, people's confidence in their financial literacy doesn't drop as they age. In fact, one study found that older people had a lower understanding of insurance and yet greater confidence in their understanding. Thus, not only will many of us someday lose the ability to make sound financial decisions, but we may be unaware of the loss. So it's a good idea to take some steps now to protect your future self from bad decisions you haven't yet made. Unfortunately, I don't know of a perfect solution to this problem. I actually don't think there is one, at least not yet. I'm going to suggest a few possible or partial solutions. The first is to acknowledge that you, yourself, could someday suffer from cognitive decline that prevents you from making good financial decisions. Think about who you would want to have make financial decisions for you if you were unfit to make them yourselves. Sometimes your children are a good choice, sometimes not. Some people will want to have a paid professional fiduciary manage their finances when they can no longer do so. Talk to your spouse, your children, your attorney, your financial advisor about what will happen if you can't make sound financial decisions yourself. If you have assets in a trust, you can appoint a trusted person as a co-trustee while you are still competent, with provisions for him or her to take over as sole trustee when you aren't. Alternatively, you may give a trusted person power of attorney to make financial decisions for you. While both of these approaches lower the chance of you making a disastrous financial decision, you probably still could find a way to do so. If you're married, start sharing the responsibility for investment and financial decisions while you and your spouse are both still competent. For decades, my father handled my parents' investment decisions. He enjoyed doing so. However, since my mother wasn't involved in these decisions and Dad had done pretty well so far, she assumed he knew what he was doing when he canceled his long-term care policy. Discussing and making financial decisions together also better prepares the surviving spouse for financial life after her or his partner dies. While you are still completely competent, choose a financial confidant, a family member, a trusted friend, a financial advisor, if possible, someone younger than you, and develop the habit of discussing every significant financial decision, major purchases, investments, insurance, with this person before you act. At first, these discussions may seem trivial and unnecessary. You know what you're doing, so why waste someone else's time? but it's important to check in with this person every time you're considering a financial decision. Why? Because you're trying to establish a dependable habit, and you want that habit firmly in place before you need it. And watch out for scams. Don't do business with people you don't know, or those who call you up on the telephone or send you an email. Don't attend free lunches or dinners offered by companies selling investments or real estate. The free dinner or the free lunch makes people feel that they owe the company something and thus more vulnerable to the ensuing sales pitch. And there are lots of scams out there. Some years ago, my mother-in-law got a call from someone who said, "Grandma, Grandma." Grandma jumped to the conclusion that it was her grandson, Abraham. When she asked why he didn't sound like himself, he answered, "Oh, I've just been in a car accident. I broke my nose. I really can't talk much." What did Abraham need? He needed money, and he wanted that money wired from Walgreens. She sent the money without verifying that the real Abraham, who, by the way, doesn't even have a driver's license, had not been in an accident. Many of you have probably received calls from the IRS claiming that if you don't immediately send money, you're going to be arrested. Or from Social Security claiming that your Social Security number has been canceled and that you'll lose all benefits unless you immediately send money. These are scams. The government will never call you out of the blue to ask for money or for your personal information, such as Social Security number, bank accounts, credit card numbers. Anyone who tells you to pay by Western Union, to go to Walgreens to pay by MoneyGram, or by putting money on a gift card is a scammer. Today we're meeting on Zoom rather than in person at St. Paul's Tower because of COVID-19. COVID-19 is a crisis for our society. However, it's an opportunity for scammers. As of April 15th, 2020, the Federal Trade Commission had received over 18,000 reports of COVID-19 scams, leading to over $13 million in losses to fraud. Nobody's going to call you from the Treasury Department asking you for your financial information in order to get release of your COVID-19 relief funds. The FCC Financial Care Center is not going to text you with an offer of $30,000 in COVID-19 relief. Phone calls purporting to be from the World Health Organization or other charities asking for money to fight COVID-19 may be scams. Don't give your credit card information to someone who calls you. Don't click on an email or text link, even if it looks legit. If you want to give, make sure that you initiate the call or that you go to the charity's real website. Text messages from Health and Human Services regarding mandatory COVID-19 testing are a scam. Robocalls offering free COVID-19 testing, scam. So that's about it about scams. Finally, I'd like to say, try to keep yourself cognitively healthy. The best way to do so is to exercise regularly. And by the way, how's your hearing? Recent studies find that people with untreated hearing loss are much more likely to develop dementia. So if you have trouble hearing, get a hearing aid and wear it. I always wear mine. And actually that's all I had to say in terms of like prepared remarks. I'd be happy to try to answer questions.
Okay, thank you, Terry. I appreciate that. This is Linda again. I'm going to curate some questions that were asked in the beginning of our presentation, and then if anybody in the presentation or in the audience would like to ask a question, please either use the chat feature or the Q&A feature. That's the raise a hand is not enabled for this particular webinar, just to the very large number of participants. So, first question. What questions should I ask before making the decision as to whether or not to decline the 2020 MRD/RMD mandated as a possibility in the new economic stimulus legislation?
All right, so I guess that I don't know the details actually here. I think the question is, if you're given the option of not withdrawing the required minimum distribution from your 401k plan or from your IRA, should you or should you not? Let's just talk about the general principle, which is if you need the money, obviously, you're going to take it out. In most, for traditional 401ks and IRAs, the money is taxed as ordinary income. So the one situation where if you're not required to take it out that you may choose not to is if you have enough money to live on, and thus you can allow the money that's in that fund to continue to grow without being taxed.
Okay.
So yeah, that's what I see as the trade-offs.
Okay. A couple of questions about long-term care policies. So I'll try and kind of group those together for you. Do you feel that long-term care policies are still a good idea? And how do you know when long-term care insurance is accepted at different communities?
Okay. Long-term care is, as I'm sure most people in this audience already know, very complicated. Basically, there are three approaches to dealing with long-term care. One is if you have enough in assets and in a support network, you self-insure. In other words, you hope that you can pay for whatever you need out of your savings when the time comes. On the other extreme, if there's just no way you're going to be able to afford a long-term care policy, you hope for the best and essentially exhaust your assets and then rely on Medicaid. And then the in-between is long-term care. When long-term care policies first became popular, the insurance companies actually made either the policies too generous or the premium too low, depending upon how you look at it. And many insurance companies were losing money on this. Subsequently, what they did is what you might expect. They raised the premium, and sometimes they were raising the premiums for people who had already bought policies. They would just, the premium had not been set for the life of the policy. It was simply they couldn't charge you more than someone else. So they raised, so there are examples of long-term care policy premiums that went up substantially and made it hard for people to keep paying. Another problem with long-term care policies is that you are contracting, it's a very complicated contract. And when you need it, you're not going to be in a position to really argue or litigate. It's possibly that your children will be able to do so on your behalf. But the policies stipulate what constitutes a need for care and what the level of care is. And because a policy is being written now that you may not need for another 10, 15 years, things may change, care may change. One final thing, and I realize this is not a complete answer, but this is a really big topic, is that for long-term care policies, I think it's important to check the financial health insurance company, because you're buying something now and you're buying something now to protect you significantly into the future. So you want to make sure that that company is still financially sound. And I would at least check to see whether it has a good reviews in terms of customer ratings currently. Of course, that doesn't guarantee that 10 or 15 years from now, the company will still treat its policyholders well. But you should make sure that they at least currently are.
to address the second part of that question about knowing whether a long-term care policy is accepted by a community?
Knowing whether it what?
I'm sorry, I was fielding that to
Oh,
Betsy. So
yeah,
you can
I
answer
think
that.
that I don't know. So I guess the question is, you're either going to have to ask at the facility or ask the insurance company explicitly about, would this be acceptable? I don't know of, that's a problem I haven't yet personally encountered. I think so it sounds like it's very analogous to you're getting, you go to see a doctor, and these days, if you have any sort of procedure, you just have to check to make sure everyone's in network. And sometimes it's absurd, by the way. I had, as I'm sure almost everyone is sitting on this call, I've had colonoscopies. The last time I had one, I checked to make sure the doctor was in network, that the facility was in network, and that the anesthesiologist was in network. The doctor took a biopsy, mentioned I was groggy. He said, oh, by the way, I took a biopsy. I don't think it's a problem. We'll have results in a couple of days. I said, yeah, doc. Turns out he sends it to a lab that's not in network, and I get a bill for about $1,000. Now, I've pushed back, and approximately, I read a study that said half of the claims that people protest and appeal in California eventually get paid. So I did push back, and eventually the insurance company said as a one-time courtesy, they would pay it. But I think just as it's true when you're having medical procedures that you need to make sure if you have a PPO or an HMO that you're in network, it'd be a good idea to check directly with both the insurance company and the facility.
Okay. Just as someone who works at a CCRC and deals with this question a lot, most Covia's CCRCs do accept long-term care insurance. However, you need to check your policy is the most important thing, your policy provider. Check with your policy provider, see what limitations they have on covering your expenses. But really, that's kind of what they're set up to do, pay for assisted living, skilled nursing, memory care type coverage. So usually they will, but as you say, you need to check with with the company that's holding your policy.
Yeah, probably this question should have been directed to you to begin with, because you know a lot more about this topic than I do.
Okay. Well, we'll switch to another question now. We have a couple of questions about determining competency, and I don't necessarily know that this is in your bailiwick either, but this can be a very complicated process, and the decision is very critical. What criteria might you include in a living trust that would provide guidelines for determining competency? As a secondary part, what do you do if you give your children power of attorney and they question your competency before you agree with that decision?
Right. It's a really good question, and I don't have a really good answer. I'd probably do some research as to what are assessments of competency for part one. For part two, I think the important part is getting part one right, because almost certainly when you are not competent, you are initially not competent by the standards that you yourself agreed to, you may still think you are. And thus, the fact that you disagree with your children doesn't mean that you're right. This is in many ways analogous to driving. Many people, as they get older, become less competent behind a wheel, and often they continue to think they're competent beyond the point when they actually are. So I do think it's important to come up with criteria in advance, and have a discussion with your doctor, have a discussion with your attorney if you have one, have a discussion with your children or whoever is going to take over for you. And get the criteria right so you're comfortable with them now. And then the fact that you think it's a little too early may not mean that it is a little too early.
Okay, let's swing in a slightly different direction. Is it wise to pay off your mortgage instead of investing in the stock market? And what do you think of reverse mortgages for somebody who is in their 70s?
All right, number one, probably. In many, okay, what makes sense in terms of your investment is going to depend on a lot of stuff. It's going to depend how much money you have. If there's many of the people, I don't know what percentage of the people who are in this webinar came through the retired from the UC system. Those who did have defined benefit pensions, which are a great thing, and as you know, disappearing from the world. And that means it's basically an annuity. In fact, it's an annuity with an adjustment for the cost of living. And that means you're not going to outlive that income because it stays with you for the rest of your life. In general, if you have a lot of money and you know you're not going to outlive it, and so it's just a matter of leaving money for your heirs, then it might make sense to leave the money in the stock market. However, if you're counting on that money to support you as you get older, then I would say paying off your mortgage is a safer bet than the stock market. The stock market in the long run is going to, the stock market. So what you're really comparing is the interest rate on your mortgage to the return on the stock market. The stock market in the long run is going to outperform the 3 or 4% that you're probably paying on your mortgage. But over any 10-year period, it could easily go the other way. So if you're counting on that money, the stock market is not the best place to have it. And as far as reverse mortgages, again, the thing is, reverse mortgages are very good for some people, and a lot of people, they haven't been so good. And this is also an issue that has to do with how much you have in assets and whether you have heirs and that you anticipate that you're going to be leaving something to your heirs, or are you just focused on getting through life yourself? If you're not worried about leaving money for your heirs, the reverse mortgage is one way to basically stay in your own house and take some of the equity out to support you through life. The interest rates are a little higher on reverse mortgages than they are on regular mortgages. There are limits as to how much you can borrow. I think the upward limit currently is about $765, I believe. But that doesn't mean you can borrow that much, because how much the reverse mortgage company will lend you is going to depend how old you are. The older you are, the more they're willing to lend you because they figure they'll get paid sooner. The worry of the reverse mortgage company is that the value of that mortgage as it grows and grows, because you borrow money and what you owe just keeps growing and growing and growing, and they're worried that what you owe will exceed the value of your home if you live too long. So really, my answer is, I guess the short answer is, get advice from a financial advisor, from someone other than the person selling you the reverse mortgage, and make sure that someone who is competent and you trust carefully reads this contract. I mean, or you, if you feel competent doing so, because the details are of some importance. So, oh, and by the way, there is another option. Full disclosure, I've done some work with this company, but there's a company called Unison, which has, they will make an equity investment in your home. They will give you money now for an ownership share in your home. The contract lasts up to 30 years. They will never force you to leave, but when you sell, they get to participate in either the gain or the loss in the value of your home. So it's a viable alternative to a reverse mortgage. And if you're considering a reverse mortgage, I would also take a look at Unison's website and what they are, what they're offering.
Okay. We have a question. Is it wise to withdraw from your 403B to invest in real estate?
Is it? All of these questions are really depend a lot on your circumstances. So in general, I would say for most people, no, but I can easily think of circumstances where the answer would be yes. So why no? Well, for one thing, when you take the money out of that 403B, you're going to pay taxes on it. And currently it's growing untaxed. And I'm not quite sure what one means by investing in real estate. You can invest in real estate within the 403B by buying what are called REITs, real estate investment trusts. They trade like stocks. And they REITs either generally are own apartment buildings or own office buildings or own both. So if what you're thinking about is taking money out to, say, buy a house or a building that you're going to manage as a landlord, that's a big undertaking, and that's going to, the advice as to whether that's a good idea or not is going to depend a lot more on your ability to do that. So, if you're investing in real estate, then presumably that real estate is being rented. Now a lot of issues come up, like how competent are you to determine what is really a good investment? How competent are you to be a landlord? If you're not going to be a landlord, that means you're going to be paying a management company. Are you going to pick a good management company? This is kind of like going into, becoming a business person in a small way. And, it's a complicated, big decision. For some people, it might be a good decision. For most people, no. If this is your idea, it's probably a better idea than if someone's trying to sell it to you.
Okay, and again, these questions may be a little bit more in the bailiwick of a fiduciary, but we'll put them out there and you can decide whether you want to address them. But what would your recommendation be for people who have savings accounts that are not earning interest? Is there a way to move that money so that it earns some kind of return? And is there a recommended investment pathway for small sums of money at a time, up to $10,000?
Sure. All right. So there are safe investments that will earn some interest. Right now, if you have if you have a savings account at Wells Fargo, I don't know what they're paying, but it's probably like 0.1% or something. Everyone talking, listening to this managed to make it onto a Zoom call. So most of you can get out your Google browser and you can do a search on which banks have the highest interest rates are paying the highest interest rates on savings accounts. The last time I looked, you could get about 1.5%. Is it a huge amount of money? No, but if it's FDIC insured, it's safe, and it's a lot more than 0.1%, a lot more. So that's one option. Another option is certificates of deposits. Generally speaking, they're extremely safe, right? Again, I looked a week or two ago at this, and the rates going out for shorter periods, like for a year or so, are also in the 1.5%, maybe 1.6% range. As far as the amount of money goes, most of those savings accounts, there's no minimum. These certificates of deposit, sometimes you get a slightly higher rate if you put down a minimum of $5,000. Disadvantage of the certificate of deposit is you're going to not get that interest if you have to make an early withdrawal, unlike a bank account where you can withdraw whenever you want.
Okay, a couple of more investment questions specifically. And these are a little bit more related specifically to the effect of COVID-19 and sheltering in place and the changes that we're seeing in the our current situation. With the stock market upheaval and the high rate of unemployment, should retired people put future investments and maybe even present ones into cash? And then how do we cope with the swings of the market which affect our bottom line?
All right. So, the tough question. If you're retired, unless you have a lot of wealth, so you're playing basically with what you're leaving your heirs, not with what you're counting on for yourself, you shouldn't, most of your portfolio shouldn't be in the stock market to begin with. You should probably have less than 50% of your investable wealth in the stock market by the time you hit retirement. Most financial advisors are going to tell you that in the long run, when you're looking out a decade or so, you're better just riding out financial crises. I don't know what's going to happen. I correctly thought in February that the market would go down a lot because of COVID-19. However, I had no idea that we'd see the big rally, and to be quite frank, I don't quite entirely understand why we've seen such a big rally. I know there was a lot of stimulus money, but still, I'm probably on the pessimistic side as far as how long we're going to be dealing with COVID-19. I'm not an epidemiologist, but I think it's more like 2 years, not, we're not talking, months. I think it's going to be a couple of years. It's a real problem. The high unemployment is a big problem, and it's a tough trade-off. Lowering unemployment is raising, more deaths. It's a trade-off between deaths and unemployment. So at this point, I think I would say what you want is not to have such a high exposure to stocks in your portfolio that if the market doesn't recover in the next 5 years, you're in trouble. I think it probably will, but you want, it's not a guarantee. But in general, I don't think that people should trade in reaction to market moves. I have done a study of this. It was in Taiwan. We looked at every single investor in Taiwan over a 5-year period. And we found that the individuals, on average, got market timing wrong. They tended to buy when the market had been going up, and before it went down, they tended to sell at low points. So I'm not a big fan of market timing. However, I do agree the market is, it's a very risky place right now, and I don't know what's going on. It's hard for me to see why the market would go up a lot in the next couple of years, but I've been wrong about stuff like that before.
Okay. This question is regarding whether you can provide any insight on the future viability of the UC retirement funds and how vulnerable they may be to the current economic downslide due to the pandemic. This is from a retiree receiving an annuity.
Yeah, I think about that one. I think about that one myself. So like almost all public pension funds, ours is underfunded. In hindsight, it was a big mistake to stop contributions in the 90s. We went years and years with neither UC nor employees making contributions. And then when we got a couple of significant market drops that added, we found ourselves underfunded. The pension is my understanding. I'm not a lawyer, I'm not an expert on this. My understanding is that the pension is guaranteed by the state of California. However, I also believe that if the pension was underfunded by too much, that guarantee might not be a full guarantee. A proposition could undo that guarantee. So I would say that there's a small chance going forward that that the pension plan may not be able to pay 100% of what's promised. But again, I don't have inside information about this. I'm not an expert. I wouldn't expect this to happen anytime in the near future.
Okay. Do you have an opinion about robotically managed funds through large financial institutions such as Vanguard and Charles Schwab?
Yeah. So most of, especially like Vanguard, what's Vanguard going to be doing? They're basically going to be doing asset allocation for you. I like Vanguard as a company. I have accounts at Vanguard. I met Jack Bogle, who started it, several times while he was still alive. We had lunch together at conferences and stuff. The trade-off, basically the trade-off is cost and advice. So on the one extreme, you make all your own decisions, and asset allocation, the big decision is just what we call asset allocation. How much do you have in savings in bonds? How much do you have in stocks in the stock market? How much are you keeping in cash? And then looking at how much your house, if you own a house, is part of your overall portfolio. If I would say you could make that decision yourself, and if you had some training background and you were confident doing so, that would be fine. You could talk to someone, either Schwab. I also like Schwab. I think they're a good company. They're going to give give reasonably good advice. Either they're Roboadvisors, or I think both companies have relatively inexpensive situations where you talk to someone briefly. You could also find a financial advisor, and they're a little harder to find, who charges by the hour and just sit down and get some recommendations and not have ongoing discussions with the person. If you have more wealth and a more complicated situation, then you might consider paying a financial advisor. What I don't like about paying financial advisors is that it's expensive. On the other hand, the big benefit is that an advisor might save you from an even more expensive mistake. So I think a robo-advisor is it's like a middle ground. And remember, what you're basically getting advice for is pretty simple. It's like, what percentage of your portfolio should be put in bond index funds and what percentage should be put in equity index funds. That's about all they're telling you. And if the advisor, either robo-advisor or in-person advisor, is making things very complicated, that's a bad signal, because it doesn't have to be very complicated, and because the financial services industry often uses complexity intentionally to confuse people. Brief story, I have a good friend who a couple of years ago called me up and he said, I'm having my annual discussion next week, annual phone call with my financial advisor. I hate that call because I never know what to ask. I find the whole thing confusing. He said, could you help me? And I said, Yeah, sure. Why don't you send me your last statement? He sends me his last statement, and it's the most complex thing statement I'd ever seen. He had over 300 different stocks, mutual funds, bond funds, ETFs, futures. Just it was tremendously complicated. When I talked to Max, I said, well, there's a little bit of good news, which is it seems like you're diversified, which is a good thing. But the only reason for the complexity, as far as I could see, was to make him feel like this financial advisor was doing something for him that the guy couldn't do himself. Today, my friend has an account at Vanguard.
Okay, could you address the issue of annuities, their pros and cons, different types, and in what circumstances you think they are a good choice?
Yeah. Okay. So annuities, there are a couple different types of annuities, and there are only two that I want to talk about, which is the sort of annuity that you buy today and it pays you an amount that, for the rest of your life, preferably with a cost of living adjustment, or the sort of annuity that's called a deferred income annuity. So you buy it today and it kicks in 10 years or 15 years at whatever age is on the annuity. The advantage of the deferred income annuity is it's going to be cheaper. Why will it be cheaper? Well, it doesn't start paying right now. Your money earns interest for those 10 years, say, that you're waiting before the annuity starts to pay. And from the point of view of the insurance company who's selling it, there's a chance that you die before those 10 years are up, in which case that money helps support other people who bought that annuity. So economists are generally big fans of annuity for people who don't have so much money that they know that they can't outlive it. The main value from an annuity these days comes from it basically comes from the risk sharing. You can imagine 10 people buy an annuity that's going to start to pay in 15 years. And going back to my example, let's say after 15 years, half of them have died, and that money's still in the annuity pool. That means that the others, there's more money to support the ones who are still alive. For this reason, it's not a good idea to buy annuities that have a feature where they say, well, if you die before you've received as much money as you paid in, we'll pay your heirs that amount. Of course, that sounds like a lovely, you think, well, that's great. I'd rather have that than not. The problem is, to get features like that is very expensive, or really what it means is you're going to get paid out a lot less. So most of the value of the annuity these days is coming from the risk sharing, not from the interest that your money's earning, because interest rates are incredibly low. So I have, by the way, I've made a number of videos on personal finance topics. The little talk I gave at the beginning today was based on a video that I made a couple of years ago. I also have a video that talks about deferred income annuities. If I guess we probably send out a link later if people are interested.
We can do that. What do you think about gold right now as an investment, and when is it best to buy it? And as a related timing question, is it a good time to start an account with Vanguard, or should I wait until the COVID crisis is over? I know those are two separate things, but slightly related.
Let's take the easy one first. You can open an account with Vanguard at any point. If you have assets in an account someplace else, you can open up an account at Vanguard and essentially just directly transfer whatever those assets are, mutual funds, equities, whatever. Once they're at Vanguard, then it becomes an issue. You can sell them and invest them in one of Vanguard's index funds. Vanguard's funds are very low fee. The issue is if the market goes up or down, it's sort of like if you're invested in stocks already, if the market goes up, it's going to go up for your current investments. It'll go up for the Vanguard index funds. The main difference is Vanguard is probably better diversified in charging you a lower fee. Gold. No, I'm not a big fan of gold as an investment. I also have a video where I talk a little bit about gold. And I think most of you don't, if you happen to be living in a country with an unstable currency or an unstable government, gold is an investment that you should probably give some thought to, because when everything falls apart, gold will probably hold its value. Of course, if you lived in such a country and you could get a bank account in US dollars outside of that country, that might also be a good investment. In the US, I don't think we're there. I think we still have a very sound currency, and while I have some disagreements with how our government is handling this crisis, we have a sound democracy. So I don't think that gold is, now, I'm not predicting what happens to gold, the price of gold. Gold's not a particularly good hedge against inflation. It usually does go up when there are major world crises. It didn't respond, it didn't go up all, as far as I don't check the price of gold daily. I don't believe it spiked all that much during the COVID-19 crisis. My main problem with investing in gold is this: what are you investing? You're just investing in a thing. You're not investing. When you buy a company, when you buy the S&P 500, you are investing in companies that are making things and selling things and have employees, and you're buying part of the economy, not all the economy, but you're buying part of it. Buying gold, I guess you can buy gold if you really think that our society is going to fall apart in a hurry, and that you're going to be able to talk someone into that it's real gold. Yeah, I'm not a big fan of it as an investment.
Okay. In the interest of time, we're getting pretty close. It's about 11:55, so I think we'll wrap up with this final question. If we didn't get to your questions, we'll try and do it offline. I think the few remaining questions were probably already addressed to some degree, but so this is for you, Terry. If you personally were to retire today, would you choose the lump sum or monthly payment?
Monthly payments.
Oh, that was quick.
That decision I made a long time ago, and I review it. It's not like I didn't. No, absolutely. Let me give you a way of trying to figure out which to do. Take a look at what the lump sum is, and then go and look to see what it would cost. Take that money and say, with this money, I could buy an annuity that would start to pay me every month, that had a cost of living adjustment, and find out what that annuity would pay you. Find out what a good, solid insurance company would give you in annuity payments for that lump sum. And almost certainly, that lump sum cannot buy you anything approaching what your UC retirement payments will be. So and you can say, well, that we just discussed that there's some risk in the UC system. Yeah, there is some risk. It's not a risk of going to zero, but there's some risk. There's going to be some risk when you give your money to an insurance company. I just think that, in my opinion, it's a very sad thing that defined benefit pensions are largely a thing of the past. I think it's a very bad thing that we've switched over to 401k plans and 403b plans. They solved a couple of minor problems that could have been solved in much better ways. The main appeal has just been that companies like them because they don't cost the company as much. They are lower cost and lower risk to the companies, and they are lower benefit and much higher risk to employees and future retirees. So don't take the lump sum. That's my opinion. I'm not a financial advisor, but you asked what I would do. Absolutely, I would take the pension.
All right.